Hello guys, a very warm welcome from the team of Corporate India Consultants. We are a corporate compliance solutions provider all across India, and we help startups for setting up their businesses, and we also provide services with respect to various corporate compliances like income tax, service tax, sales tax, or local VATs, and we are also providing tax planning and tax consulting services to big corporates. Today, we will be discussing with you the goods and service tax in Indian context. So, friends, it is one of the biggest reforms in the Indian taxation system since independence.
So guys, this is what we are going to cover in our presentation: background and overview of goods and service tax, registration process, GST return process, GST payment process, and GST refund process. And we will be having a small slide on process compliance related readiness for the corporates. Now starting with the GST background and overview. So the journey so far, you can see in my screen that in year 2007 the Joint Committee of State Finance Minister was set up by the Ampar Committee, and this submitted its report in year 2009. And in year 2011 the constitution amendment introduced for imposition of GST bill was lapsed with the dissolution of Lok Sabha, and finally this bill got passed in the year 2015 on 6th of May in Lok Sabha, but still it is pending in Rajya Sabha because the current government doesn't has the majority in Rajya Sabha. But we are hoping that this bill will be passed in the coming budget session, and let us keep our fingers crossed that it gets passed, because if it is passed then it will have immense benefits for the corporates and the trade across the country, and it will help in ease of doing business. And the road ahead is that this bill is to be passed in upper house called Rajya Sabha by 2/3 of the majority, and then it is to be ratified by at least 50% of the total states. Once it is ratified by the states, then presidential consent to the constitution bill will be required, and post that the approval of this bill is to be sanctioned from both the houses of parliament for IGST and CGST acts, and by the local state legislatures for the SGST acts of the various local states legislatures. As per the Arvind Subramaniam committee report, if the bill gets clear in this time, that is within the budget session, then it may become applicable from 1st September 2016. So now guys, this is what the present indirect taxation structure in India is, and as per Article 265 of the Constitution of India, no taxes shall be levied or collected except by authority of law. So if you see in this diagram, we have three buckets. One for the central government. So the central government has authority to collect these taxes called custom duty, excise duty, service tax, central sale tax, and R&D. So custom duty is basically collected on imports, excise duty is levied on the manufacture of goods, and service tax is levied on the provision of services, while central sale tax is levied on sale of goods from one state to another, and R&D is the research and development cess that is also being levied by the central government. Now coming to the state government taxes, so currently we have local VAT, entry tax, purchase tax, and entertainment tax. So these taxes are also being paid by the traders along with the central government taxes. Suppose a person has a factory, he is manufacturing goods in the factory. In that case, excise duty is applicable, plus when he is selling those goods, he has to pay the VAT or sale tax depending on where he is selling. If he is selling in the local state, then VAT is applicable, and if it's selling in outside the state, then sale tax or central sale tax is applicable. So guys, there are multiple taxes that are to be paid by the corporates, and one of the biggest hurdles for all the traders now is that they are not able to get the credit of all the inputs for their output liabilities, because so guys, you can see that GST will subsume all the existing central and state taxes. So all the local bodies, state government taxes and the central government taxes will be subsumed into one bucket, and now the central goods and service tax, state goods and service tax, integrated goods and service tax and additional tax will be levied. Liability to pay GST vis-a-vis existing indirect taxes. Under current indirect tax regime, different taxes are levied on different events. So if you see here, on manufacture of the goods, the excise duty is payable. On sale of goods, the VAT called value added tax or CST called central sale tax are payable. And for provision of service, the service tax is levied. Similarly, for import, the custom duty is levied. Now under GST regime, the goods and service tax shall be levied on supply of goods and services. So there will be only single event on which a single tax is to be paid by the taxpayer. So it will be easier for the taxpayer from compliance perspective, and there will be very less cost of compliance for the dealers once GST comes into picture. The intent of automation is clearly visible as per the business process documents, and based on the GST business process documents that are available on mygov.in portal, it seems that intent of government is to build a complete paperless system. This is based on the premise that there shall be lot of auto population and automatic generation of data with respect to registration forms, return forms, or in the payment challans based on the data that is already available in the GST system. Also, transaction level data is required from the taxpayer for proper flow of the credit from one stage to other, and minimum chances or minimal chances will be there for the leakage of revenue for the government. And GST is not only replacing the taxes, the whole design has been changed, and it is based on the premise of information technology, and it is a commitment of the government that there will be an ease of doing business in India post GST regime. So guys, the scenario with respect to the export oriented units called EOU, special economic zones called SEZ, and software technology parks or STPs under GST will be as follows. The exports and SEZs, that is the export would be zero rated as currently they are. In case of SEZ, if the supply of goods or services is for consumption in processing zone, then it would be zero rated by refund mechanism. So first of all, the duty will be paid, but that will be refunded later on. Imports, as far as the custom duty is concerned, that will be continued to be levied on the imports, but CVD and SED will be subsumed by the IGST. So the tax called CVD, which was levied in lieu of excise duty, and SED, which was levied in lieu of VAT, these will be subsumed by the IGST. And special area schemes, basically the exemptions available under special industrial area schemes would continue up to legitimate expiry time, both for the center and the state. And after the introduction of GST, the tax exemptions or remissions that are currently available with respect to industrial incentives would be converted, if at all needed, into cash refund schemes.
So there are some items that are out of GST ambit or on which GST will not be levied, such as petroleum products, alcohol, electricity, and real estate sector. So friends, on some of the items, the GST will not be applicable. But it doesn't mean that if GST is not applicable, then these sectors will not be covered under any other taxation system, because the existing indirect taxes will be applied as it is to these sectors. And the problem with these sectors like alcohol or electricity, as the case may be, is that they won't be able to take the credit of the input tax which they have paid under GST on their inputs, as their output liability is not to be paid under GST. So their cost will increase once GST comes. The structure of the GST in India will be a dual structure, because center will levy central goods and service tax and states will levy state goods and service tax. So under dual GST, many countries in the world have a single unified GST system, that is a single tax applicable throughout the country. However, in federal countries like Brazil and Canada, a dual GST system is prevalent, whereby GST is levied by both the federal and state or provincial governments. Similarly, in India, a dual GST is proposed, whereby a central goods and service tax and a state goods and service tax will be levied on the taxable value of every transaction of supply of goods and services. Integrated goods and services shall be levied on interstate supply of goods and services. Now, here you can see that levy of GST on supply of goods and services, uh, if it is sale or supply, I will not use the word sale, because supply word in itself covers sales and provisions of services, that is sales of goods and provision of services. So if a supply of a good or service is within a state, then CGST plus SGST will be applicable. So suppose if you are buying from a retailer any e-label or any item on which GST is levied, then you will be paying him the CGST and SGST. This CGST will be central goods and service tax, that is the central portion, and this SGST is the state goods and service tax, that is the state portion of GST. And if there is a supply of good or service outside the state, in that case there will be integrated goods and service tax plus additional tax liability. And in every case, as GST in its very essence is a tax on destination or consumption principle, so the tax will be collected by the state where the goods or services have been sold or supplied, as the case may be. So as far as the additional tax is concerned, it shall be levied at the rate of 1% on interstate supply of goods and services, and will be credited to the originating state. Again, the additional tax, why I have mentioned this point here is that because the nature of GST is that it will be collected by the destination or consuming state. But additional tax is against the principle of GST. And the intent of having additional tax is that the origin state or originating state should get some compensation, because under the existing regime the originating state is getting the revenue. So as to compensate them, the concept of additional tax has been considered under the GST also, though it is opposed by the opposition party. So it may not come when the final GST is out. So guys, as we have already discussed that most of the taxes under indirect tax system will be subsumed by the GST under the new indirect taxation system in India. So most of the tax paid on the inputs at various steps will be available to the taxpayer or dealer as a credit on their output tax liabilities. So the importers, when they are buying anything from outside the country, they are importing anything, in that case they will pay the IGST and the customs. So when they sell that good or service to the manufacturer, basically in this case if you see, we have taken an example for the goods only. So the importer buying a goods from outside the country, they will pay the IGST. Suppose that this port is Vishakhapatnam or Vizag port. So from this port, suppose a manufacturer in UP has bought that from this importer. So this manufacturer will pay him the integrated goods and service tax, because in this case the import has been done in Vishakhapatnam and the importer from Vishakhapatnam has sold that good to the manufacturer at UP. So in this transaction, IGST will be paid by the manufacturer of UP. Suppose that manufacturer of UP sells that good to any wholesaler within UP itself. In that case, that manufacturer has a liability of CGST and SGST, called Central Goods and Service Tax and State Goods and Service Tax. So in this case, the credit of this IGST which the manufacturer has paid to the importer will be available to him while discharging his CGST and SGST liabilities. And we will take you through the prioritization rule, or the rules of set off of input tax credit under GST in the coming slide, where it will be clear to you that how the credits will be utilized on the inputs and outputs, because we don't have much restrictions, but there is a small restriction also. That is I cannot say it a restriction, it's an exception to the basic rule of ITC credit flow, that we will cover in the next slide. So in this case, you can easily visualize that credit of tax paid on one step is easily available at the, or easily available for the output tax liability payment. Now suppose, continuing this example only, this wholesaler has sold the goods to the retailer. So now what this retailer will do, the retailer will, suppose this retailer is not in UP, he is in Delhi. So this retailer will pay IGST again to this wholesaler, and this wholesaler has paid CGST and SGST, so he can take the credit of CGST SGST for meeting up his IGST output tax liability, which he needs to collect from the retailer and pay to the government account. So at every stage except the final consumption stage, when the retailer sells out the goods to the final consumer, this retailer will collect the tax from the consumer and he will take the credit of the IGST paid to the UP dealer. That is, this Delhi retailer will pay the liability after taking the credit of IGST which he has paid to the UP wholesaler. So the final consumer will bear only the tax amount that has been levied by the retailer on his cost. So GST is a tax on goods and services. with comprehensive and continuous chain of set of benefits from the producer point and service provider point up to the retailer's level. It is essentially a tax only on value addition at each stage, and a supplier at each stage is permitted to set off through a tax credit mechanism the GST paid on the purchase of goods and services as available for set off on the goods as available for set off on the GST to be paid on the supply of goods and services. So it is easily explained in the example that we have just taken, that the GST paid on the purchase of the goods and services as available for set off on the GST to be paid on the supply of goods and services. The final consumer will thus bear only the GST charged by this last retailer in our example, this Delhi retailer, which he is charging to his final consumer will be the only amount on which the tax is to be levied and to be paid by the final consumer. Now again, suppose this final consumer is from Delhi only. In that case, because we have taken an example of the goods, so in this case, it won't be a situation that this final consumer is from some other state. But there are stages where the final consumer will be from some other state, and in that case, like e-commerce services or online services, in that case. The credit should flow to the that respective state. Suppose. So guys, as we have discussed in the previous slide, that there is some utilization pattern for the input tax credits, because we have different type of input tax credit under GST also, as far as the type of taxes are concerned. So on a local procurement of a goods or services, the SGST and CGST is applicable. So this local procurement means that is buying any goods or service from the local taxpayer within a particular state. And in case of interstate procurement, the IGST or integrated goods and service tax will be applicable. Similarly, for the output supply of goods and services, if it is done within a local market or within a state, in that case SGST and CGST is applicable. And if it is done outside the state, then in that case IGST is applicable. So now how this utilization pattern of different input tax credit either paid on the local or the interstate procurements for the liabilities for the supply of goods and services to be done outside the state or within a state by the taxpayer is discussed in the next slide. So this is the mechanism of input tax credit utilization under the GST. So CGST, if you see in this example, this CGST can be used as a credit for the payment of CGST. Similarly, SGST for the payment of SGST and IGST for the payment of CGST or SGST as the case may be. So the ITC of CGST can be utilized for the payment of CGST, ITC of SGST can be utilized for the payment of SGST, and ITC of IGST can be utilized for the payment of CGST and SGST. Now the problem comes that the gross utilization of a central tax cannot be done for the purpose of payment of the state tax and vice versa. That is, the credit of SGST cannot be used for the payment of CGST, and credit of CGST cannot be used for the payment of the SGST liability. So in this next box, we have IGST, CGST and SGST. So basically IGST can be used for the payment of IGST, CGST and SGST, but the pattern will be as follows. So first of all, IGST will be utilized for the payment of IGST, then for CGST and then for SGST. Similarly, if CGST credit is to be taken, it can be taken for CGST liability as well as IGST liability. But the pattern will be that first of all, if any CGST liability is there, it is to be used for that. Post that, if any balance of CGST credit is left and there is IGST liability, then it can be used for the IGST liability. Same rules applicable for SGST and IGST. That is SGST credit to be utilized first for the SGST liability, then for the IGST liability. But cross utilization of CGST and SGST will not be allowed, as these two taxes are the different nature of taxes. One is to be levied by the center and other to be levied by the states. And from its very nature, IGST has is to be considered as a tax which can be used as a credit either for a central tax liability or a state tax liability. So this IGST, as per the process documents, this IGST the will be basically be managed by the central government, but the credit of this can be used for liability of central tax or state tax, as the case may be.
guys guys, now starting with the GST registration process. So first of all, we will see why there is a need for taking registration. So it is required that supplier or dealer should be registered to be legally recognized as a supplier dealer under GST, and it will provide a unique identification code called GSTIN, called Goods and Service Tax Identification Number, from the tax authorities, so that all the operations of and the data related to the business can be correlated, and it will also help in proper accounting of the taxes, and also to pass on the credit of taxes paid on the goods or service supplied to purchasers. So GSTIN, basically Goods and Service Tax Identification Number, will constitute of the following parts. So if you see here, the state code is the first and second column of this table. It's not a table, basically these are the digits. So it will be a 15 digits number. First two digits will be the state code, next 10 digits will be the PAN number of the SSC, 13th will be the entity code, and this entity code would be alphanumeric number, and total entity codes can be up to 35 because it is from 1 to 9 and then from A to Z. So 9 plus 26, 35 entity codes can be there. 14th digit of GST would be kept blank for the future purpose, and 15th digit is something related to the system validation or the uniqueness of the GST. SSC would be required to have state specific registration, so the state code will vary as per the state selected by the taxpayer. Registration form filling and filing and processing will be done in the online manner only. There will be no physical documents that are to be submitted, and site visits by the inspector will be post GST registration and shall be based on certain risk parameters. A maximum time limit of 3 common working days for approval by the registration authority. Registering authorities will be center and state, and GST system will automatically generate a registration certificate if no response is received from jurisdictional authorities. So if you see here, we have mentioned 3 common working days because this common working days stands for the center and state, because center and state have different holiday list. So 3 common working days will be seen, not working days. GST system will automatically generate registration certificate if no response is received from the jurisdictional authorities. In case of any query, it has to be communicated to the applicant and other tax authority within 3 common working days. Again, common working days is mentioned here. Such query can be raised only once. So the authorities can raise their query only once, and in case of any query, it is to be communicated to the applicant and other tax authority also. That is, if center is raising any query, then it will intimate it to the state and vice versa. Applicant will reply or rectify the errors within 7 common working days from the date of receipt of the query, and jurisdictional authority will have 7 working days to respond. In case application is refused, the applicant will be informed about the reason for such refusal through a separate order or a speaking order, and applicant shall have the right to appeal against such order. Auto prefill of maximum fields in case of additional registration or any other registration will be done, and central or state authorities have the power to cancel the registration. Submission of form through TRPs and FCs as well as offline utility will be done, and status tracking facility will also be available. Auto migration of existing taxpayers to the GST system will be done. So guys, who needs to take registration? Basically regular dealers, if their turnover is above the threshold, or they are doing any interstate supply, or liability to pay under reverse charge is there, then a person is required to register as a regular dealer. And if tax at a specified percentage of the turnover is to be paid by the taxpayer and they want to opt the composition scheme, then they will be required to register as a compounding dealer. Similarly, registration for the casual dealers and non-resident Indian dealers will also be provided through the registration form, and the registration will be for a limited period which is to be renewed. And ISD will also be granted registration separately, and they have the facility to distribute the credit of the GST paid on their inputs. And non-resident foreigner dealers are also required to take registration and to file their returns, and their registration will also be for a smaller period, shorter period. The point or the catch here is that casual or non-resident Indian dealers have a small difference. Casual dealers are those dealers which are basically doing trade fairs, etc., for a limited period of time. But non-resident dealers or non-resident Indian dealers, I will say, they are those dealers which are providing their services in a particular state for a limited period of time, but they are already been registered in some other state. So in case of a casual dealer, the security will be higher at the time of registration. They will be giving more security amount, but the non-resident Indian dealers will not be paying any security amounts, because if any dues are there, that can be recovered from them from their registration in other states, because they are registered in other states, so they are easy to catch based on their PAN numbers. UN bodies and government agencies and PSUs will also be required to take registration as per the GST registration process. Existing registered suppliers, dealers under center and state laws like VAT, SAT, ST and VAT are basically service tax and value-added tax. So basically these dealers will also be required to get themselves registered, but most of their data or some of their data is to be filled by them on the GST portal, and some of their data will be migrated from their existing systems, and they will be issued GST before without filing any registration applications. That will be the benefit for them. So these are the ways to register. Basically, one is the migration from earlier regime. In that case, there is no application to be filed. Only the particulars or the details left over or not available with the GST are to be filled. In case of new user registration, there is a facility to self-register yourself through GST portal or take help of TRP or FC. So guys, now starting with the returns overview. Monthly returns for regular dealers, and there will be three type of returns to be filed by the dealer on a regular basis, that is on monthly basis. So the first one is the outward supplies return or the sales return, that is to be created by the dealer. The GSTR2 will be created based on the details of the sales filed by the respective suppliers in their GSTR1. Only the missing invoices have to be added by the taxpayer in his GSTR2, and he can file it after that. So this 1 and 2, once these returns are filed, then GSTR3 is to be filed, and we will talk about the due dates of these returns in the coming slides. Now coming to the next return, that is quarterly returns for composite dealers, that is to be filed in GSTR4. Simple returns for non-resident taxpayers, foreigners, is to be filed in GSTR5. Uploading of only outward supplies, as I already told that only outward supplies will be uploaded by the dealer. The same will be auto-populated in the inward supply of the counterparty. So the dealer has only to add his missing invoices in this case. So if you can see in this point, facility for buyer to add invoices missed by the supplier for claiming ITC or input tax credit. Invoice wise or HSN SSC code wise data of outward supplies to be maintained and uploaded by the dealer. So one of the important points to be noted here is that invoice wise, and not only invoice wise, but that is HSN SSC code wise. So line item level details are to be filed by the dealer. No duplication of detail of invoice will be allowed. So if an invoice is uploaded once, it cannot be uploaded again. And if invoice is added by the recipient, then also in that case it cannot be uploaded either by the receiver again or the supplier. No revision of any GST return shall be allowed as per the process documents. Uploading of invoice details in phased manner will be allowed. So the invoices can be uploaded in tranches. Tranches means that the dealer will have an option that he can upload the invoices starting with first day of the tax period month till 10th of the succeeding month. And validation on GST of buyers and sellers, and on the import export data from CBEC and DGFC systems will be done. Auto generation of purchase detail based on outward supply return filed by the vendor. Facility to file corrections in subsequent return period is also provided. And auto creation of monthly returns based on invoice details uploaded through GSTR 102. And also the facility to file the returns through TRPs called tax return preparers. Basically TRPs would be CAs and the sale tax practitioners or STPs, and FCs can also help in filing the returns. Facility to file the return using offline utility and through GSPs called GST Suvidha providers. For any mistake, error message will be displayed to the dealer. And in addition to the data to be filed by the dealer with returns, there will be a creation or auto creation of the tax ledgers, and these will be 3 tax ledgers. One will be the tax liability ledger, second one will be the cash ledger, and the third one is the input tax credit ledger. So basically tax liability ledger will involve the liability on account of different period returns plus any demand from the department or any other liabilities of the SSC, either due to reversal or mismatch of the invoices. Cash ledger is basically created based on the payments made by the SSC through challans, and those payments will be credited to the cash ledger. From cash ledger it can be debited for payment or discharging the liability of the returns or other liabilities other than returns. And ITC ledger will be created based on the details filed in the GSTR2, that is the purchase return of the SSC, where he declares what amount of input tax credit is available to him. So this will be created based on the GSTR2. And again, the credit from ITC ledger can be utilized for the payment of returns or for discharging any other liabilities. So this is about the applicability and periodicity of return. The normal, casual and non-resident Indian taxpayers have to file GSTR 1, 2 and 3 till 10th, 15th and 20th of the succeeding month respectively. They have to file GSTR 8 till 31st December of next financial year. For a compounding taxpayer, GSTR 4 till 18th of a month succeeding the quarter is to be filed. That is, they have to file a quarterly return in GSTR 4. And they have also to file a simplified annual return till 31st December of the next financial year. Now talking about the non-resident foreign taxpayer, they have to file their GSTR 5 till 20th of the month succeeding the month of the tax period month, and they have to file their return till 7 days succeeding the period of registration in case registration is for a period less than a month. ISD, they are required to file GSTR 6 till 15th of succeeding month, and the tax deductors have to file their return as a TDS return under GSTR 7 format till 10th of the succeeding month. So filing of the monthly return by the taxpayer will be done as follows. So if you see in this example, there is a taxpayer 1 and the other taxpayer called taxpayer 2. Taxpayer 1 sells out something to taxpayer 2, and taxpayer 1 will declare the sales in his GSTR 1. Now that detail will be auto populated in GSTR 2 of the taxpayer 2. Suppose the invoices are missing with respect to the details that are getting auto populated in GSTR 2 of the taxpayer 2, then in that case he has an option to add invoices in his GSTR 2 that will go to the GSTR 1 of the taxpayer 1. Even if it is already filed, the taxpayer 1 has to come back and has to accept or reject this addition by the taxpayer 2 till 17th of the month. So 16th and 17th 2 days are provided to taxpayer 1 to rectify the mistakes done by him in his GSTR 1. And taxpayer 2 has to file his GSTR 1 also. Now once taxpayer files his GSTR 1 and GSTR 2, then he will be able to file his GSTR 3, that is the monthly return also. And you can see in this example that the B2B supply from taxpayer 1 will be auto populated in the GSTR 2 of the taxpayer 2. Similarly, the GSTR 1 of taxpayer 2 will have B2B, B2C and B2G supplies. The B2B is business to business, B2C is business to consumer. So this business to consumer will not be getting auto populated in any of the GSTR 2s, and this B2G will also not be auto populated in any of the GSTR 2s because it is not a B2B sale, business to business sale. Creation and discharge of liability arising out of return. On filing of GSTR 1, the liability on account of outward supplies shall be auto populated in tax liability ledger, and on filing of GSTR 2, the liability on account of reverse charge invoices shall be auto populated in tax liability ledger. Also the ITC or the input tax credit shall be auto populated in the ITC ledger. Similarly, the valid GSTR 3 shall be allowed to be submitted only when complete tax liability with respect to the corresponding tax period has been discharged by the taxpayer. So the word here used is valid GSTR 3 because there is an option to file or short file the return without payment of tax, but that will not be considered for any settlement purposes. Liability can be discharged either from the cash ledger or the ITC ledger based on the availability of credit in respective ledgers. and the liability for the corresponding tax period can be discharged either before or at the time of filing of GSTR 3. Now, starting with the concept of input service distributor, or called so-called ISD, a normal taxpayer can also be an input service distributor for distribution of input tax credit on goods and services that are received and are used for its units. So, if you see in this example, the Bangalore head office need to file its GSTR 6 for distribution of credit for the services or the goods that are used by the or for the purpose of the Mumbai or the Kolkata branch, and these details will be auto populated from GSTR 6 of this Bangalore HO to the Mumbai branch GSTR 2 or Kolkata branch GSTR 2, as the case may be, based on the distribution of credit done by the Bangalore head office. No separate registration is required. Normal taxpayer can select this option at the time of registration. In case ISD is not selected during registration, then it can be added later on via amendment application. As an ISD will file GSTR 6 for filing invoices used for distribution of input tax credit to its units, and the same will be auto populated in GSTR 2 of the respective unit or branch on the invoice level, as I already told you in this example. So same thing is mentioned here. So in case of any reversals, ISD need to pay tax demands. ISD return is to be filed monthly, and the cutoff date to file this return is 15th of the succeeding month. So concept of TDS in case of indirect tax of GST, it is as follows, that in case the supply is above a prescribed amount is received by the government department or any other specified taxpayer as per GST law, then tax at a certain percentage is to be deducted, and TDS return will be created and is to be submitted by the normal or regular taxpayer, including a casual taxpayer, compounding taxpayer, and non-resident taxpayer as GSTR 7, and these details will be auto populated in GSTR 2 of the counterparty taxpayer supplier whose TDS has been deducted, as this will be a credit for him because he has his tax has already been paid by the government department after deducting the same. Now this is a brief overview about the GSTR 8 or the annual return. All the normal taxpayers would be required to submit annual return by 31st December following the end of the financial year for which it is filled. This return is intended to provide a 360-degree view about the activities of the taxpayer, and a reconciliation of the return with the audited financial statement of the taxpayer will be done. Basically, this will be a big challenge here because the GSTR 8 is to be filed GSTIN wise and GSTIN will be state wise. So the problem here will be that the taxpayers have to proportionately calculate the turnover of their respective state, and they need to come up at a amount for different items proportionately as per the audit report if they are providing services in more than one state. So if they are providing services in a single state, then there is no problem, but if they are providing services in different states and they have been audited under 44AB, then proportionate amount is to be calculated from the 44AB audited financial statements for reconciliation with the GSTR 8. The consolidated statement of purchase and supplies based on monthly return filed by the taxpayer can be made available to the taxpayer by GSTN common portal as a facilitation measure for enabling him to prepare annual return. So this will be one of the facilities that will be available to the taxpayer to file his GSTR 8. So guys, this is how the payment mechanism will work under GST. The payment of taxes like CGST, SGST, IGST and additional tax can be made through one single challan. Basically, this is a combination of the state and central taxes, and now the government has planned that the center and state taxes will be collected through a single challan. Though this is collected through a single challan, but the payments will be accounted into the respective state or central government accounts. Challan will have major heads called IGST, CGST, SGST, and additional tax. So basically, these taxes will be called known as the major heads, and under each of these major heads, there will be minor heads called tax, interest, penalty, fine, and others. Payment can be made through debit credit card or through internet banking, and NEFT RTGS options will also be available. Over the bank counter payment can be made only up to rupees 10,000 rupees, and facility to make advance payments will also be there, and all the payments that are made in advance, that will go to the cash ledger of the SSC, and from there they can utilize and pay their liabilities. There will also be an option to pay later called pay letter option for making the payment, and based on that option, till the expiry of challan, the SSC has an option to pay the amount within a specified time limit as mentioned in the generated challan. The payment challan details except the amounts will be pre-filled based on the GST entered, and facility to make payment under different major minor head within one challan will be available. Refund can be claimed for the excess payments, and facility will be available to track payment status, and reconciliation of the incorrect payments will be done in the time bound manner. Or the main thing here, or the main facility available here, is that there is a facility to link a unique transaction reference number called UTR in case of NEFT RTGS payments options, which help in making payment from 400 unassociated banks and institutions. So guys, now we will take you through the GST refund process. So this is a brief overview of refund process. Return it itself may be treated as a refund application in specified cases as per the process document, and on filing of the refund application, a receipt or acknowledgement number to be generated and communicated to the applicant via SMS and email for future reference. Refund application to be displayed on the taxpayer's online dashboard. Credit cannot be claimed from balance available in the cash ledger or ITC ledger if the application for refund for the same has already been filed. So guys, the first point itself conveys that in specified cases, the return itself will be treated as a refund application, and the return in this case would be GSTR 3, basically the monthly return to be filed till 20th of the succeeding month. It will be treated as a refund application in specified cases, and those specified cases are available or mentioned in the process document. And on filing of the refund application, a receipt or acknowledgement number will be generated, and the same will be communicated to the applicant via SMS and email for the future reference purpose. And the refund application to be displayed on the taxpayer online dashboard. Credit cannot be claimed from balance available in cash ITC or ITC ledger if the application for refund for the same has been filed. The interest at the rate of 6% shall be paid in case of delay in refund beyond 90 days from the date of application. It is also recommended by the Joint Committee that the GST law may provide for provisions of recovery of erroneously granted refunds along with interest. So guys, these would be the situations where refund shall be allowed. Excess payment due to mistake and inadvertence by the taxpayer. Input tax paid on goods exported, and on any finalization of provision assessment, refund will be granted, and refund will also be given for pre-deposit in case of appeal or investigation. Refund for tax payment on transactions by UN bodies, CSD canteens, paramilitary forces canteens, etc. will also be provided. Refund from manufacturing, generation, production, creation of tax-free supplies or non-GST supplies shall also be provided. Refund of carry forward input tax credit, refund on account of year-end or volume-based incentives, and tax refund for international tourists. So these are some of the situations the refund shall be allowed to the assessee or the taxpayer. So GST process compliance readiness required by the corporates is highlighted in the next slide. So this is about GST process compliance related readiness. So first of all, registration related readiness is required because the business structure will be modified as in line with the requirements of GST by state and line of business. The assessee is required to register themselves and work with the accounting software vendors, ERP vendors, to update core accounting or ERP system for calculation of IGST, SGST, CGST and additional tax on invoices. And return related readiness is basically dependent on the upgradation of the accounting packages that will be helping the assessee or the taxpayer to generate data needed for returns. Prepare for the process change. So assessee is required to prepare themselves for the process change, because discipline in preparing and filing monthly returns will be required, as returns are to be filed on monthly basis in three parts. First of all, outward supplies to be finalized and filed till 10th of the succeeding month. Then inward supplies to be finalized and filed till 15th of the succeeding month. And then the final monthly return, which will be prepared from the data of the outward and inward supplies filed till 10th and 15th respectively. So this discipline in preparation and filing of the monthly return will be required by the taxpayers, that they have to file their outward, inward and monthly returns within specified time limit. Update accounting system to handle the ITC and refund processes, because input tax credit and refund processes would be different in comparison to the existing indirect tax regime. Hence there will be update required for required in the accounting system for the ITC and refund processes also. So get the impact analysis done beforehand to avoid any challenges when GST Act is in place. Thanks a lot guys for your time, and on behalf of Corporate India Consultants team, I request all of you to share our PPT to your friends and colleagues for awareness of GST, and request all of you that if you have any questions, queries or doubts regarding the GST, you just drop us a mail at corporateindiaconsultants@gmail.com, and we shall try to revert and resolve your queries as soon as possible. And we are also providing impact analysis services. So if you want any impact analysis with regard to GST, that how it will impact your entity, or you want any services related to the information technology accounting system upgradation, then we will definitely try to help you and will provide you the best solutions from our end. Thanks a lot once again.